Hey guys, we are here with Kevin Green, Sam, and this is the Commodity Report. It's on every single week at 11 a.m. Mondays, if we can make it at 11 a.m. Sometimes we're all busy. We've got a lot of stuff to do, but we got a lot to talk about today. One is the dollar. Let's start with the dollar. Sam, what are you thinking about the dollar here? Because we were just talking about this off mic. I think this is the most important theme that we need to continue to watch as traders here. What's going on with the dollar? Where's it heading? And what's the levels you're looking at?
For sure. The dollar is running into a shelf of overhead supply that has capped rallies over the last several years. In addition to that, the US dollar is entering one of its worst seasonal periods of the year. To make it even better, the US dollar does even worse during election years during this time. So, with all of that together, it makes a lot of sense for the dollar to stop going up here at a very logical level of overhead supply. You could also call it resistance. Um, you would expect it to not break out above that resistance in a bad seasonal period. I think Bitcoin looked like it was ready to go for a very long time during that consolidation, but it was just not a good seasonal period for Bitcoin. And once you got through that time, you saw that range resolve. So I'm thinking maybe this does eventually resolve higher. Like it sure does look like a smiley face, but I really don't think it's right now.
So, Kevin, what's your thoughts on the dollar?
Yeah, so the dollar has seen some positive inflows, obviously, over the last couple of weeks. I think it's multiple factors that are taking place, right? I mean, we are the best game in town when it comes to economic data. So, on a relative basis, which we have to consider the dollar or any currency for that matter, it's relative to somebody, to something else, right? It's relative to the euro, it's relative to the yen. And so we're better than the Eurozone right now when it comes to macroeconomic data. The yen, God knows that we're a lot better than what the Japanese economy is really doing right now. And so I think you are seeing some positive inflows because of that reason. I think you're also seeing this flight to quality in a sense where you're seeing individuals sell treasuries and potentially picking up dollars. And then also looking at some spreads between the dollar and emerging market currencies. I think that's also another play that's out there that major institutions really kind of leverage, not really retail traders. And I'm kind of with Sam though. I mean, obviously with the expectations of rate cuts being dampened down, it's pretty much 50-50 if we're going to get something in December or January. And you could also make the case that maybe we don't get 100 basis points next year. I mean, if we continue to stay at these levels, especially when it comes to inflation. So I think it's a multitude of areas, but I think the stronger dollar does kind of offset or maybe puts a little bit less fear into the market when it comes to tariff policy, right? Because there's a little bit of an offset if you're an international company. If you were subjected to tariffs, the stronger dollar kind of lessens the blow here. Technically, I think we do pull back. If you look at the CCI on a weekly chart, anytime that CCI hinges down, you can go on the last 3 weeks, a pullback has ensued. It doesn't mean that it pulls back and makes a new low, but a pullback does ensue, and we are hinging on that CCI if you're looking at the weekly chart here. And that could be a tailwind when it comes to gold and some of the other precious metals and maybe energy, but I don't really think so. I think there's so much of a disconnect right now in these markets, just kind of like a rebalancing or a resetting of an environment that the dollar is doing its own thing, yields are doing its own thing, crude doing its own thing, right? Like everything, the correlations that we know and love or have known and loved for the last 2 years, 3 years, for the most part, is broken. And I think we're just seeing the great reset taking place here.
You're on mute.
Just kidding. So getting to Sam's point on the dollar and seasonality, I wrote a post last week for All Star Charts, and basically was looking at the seasonality of the dollar. And I mentioned this in on my Substack. So if you guys who follow my Substack, AAO Research on Substack, you guys saw that before the election. I said, hey, there's going to be a big pop in the dollar that usually happens after the election. It can last for a few days, it can last for a couple weeks, it could last for a month. And I think we saw that, but what this seasonality chart is telling us, and the gray line is the dollar seasonality in election years, is that there's usually a pop and then it sells off pretty hard into year end as investors start to look into other areas. So once again, I think there's a lot of evidence here that the dollar probably is topping out here, hitting that massive resistance zone and then moving lower. And then we can kind of start to look at what's going to benefit. So, Sam, what are you thinking? What's going to benefit from this down dollar move that we could possibly see coming up? Where should we be positioned? How do we make money going forward? Because that's what this is all about. Let's figure out how do we make some cash.
Well, front and center for me is crypto. I think that would be the largest benefactor of a weaker dollar. Um, I think that would result in Bitcoin crossing 100K, 2% down move in the Dixie. I think that would be very welcomed by that community. For crude oil, I'm not really sure what to think about that. I think Kevin could opine on that better than I could. But I really am curious about crude oil. I think investors need to be paying very close attention to that right now.
Yeah, can I just add? So the one thing that we have to kind of figure out when it comes to the dollar, though, I want to kind of go and capstone this really quickly, right?
Please.
Geopolitical risk can create the tailwinds for the dollar as far as gaining dollar strength, right? And that's something that we've seen throughout history. So from a technical standpoint, it does appear that we want to have it kind of pull back. I think there has been some things on the radar over the last 24 to 48 hours that I would say does warrant some attention. And I just actually posted an article about this on X regarding kind of just Russia on so. Well, let me go back to this. If we have an escalation if we have an escalation, say in the Ukraine-Russia conflict, or Israel, Iran, which it doesn't seem like that is going to be the case. There has been reports that Iran has signaled from back channels that they want to squash this whole thing with Israel. Let's see if that actually is going to come to fruition. But let's say the Russia-Ukraine conflict does escalate a little bit more. That could actually inflate the dollar even more, right? So even though we can come up with those technical cases, even though we can have the macro case why we see dollar strength, and maybe it doesn't completely just pull back, or maybe it just kind of meanders around, which I think is actually good for the equity market. The equity market doesn't care about the actual dollar value or the number value of the dollar, right? All it cares about is stability. It's the same thing with yields. Yields could be at 7%, right? But if we have decent growth and it's stable at 7%, I'm just using an example, the market gets used to that. Right, recalibrates and it continues to move forward. I think the dollar is the same way. So technically, I think the dollar should come down. But I do want to say there are some things on the horizon here that could force it to go back up, just like we saw the Russia-Ukraine conflict actually break out, right? Dollar smashed to the upside. I think the dollar went up to what, 109, something crazy. Mm-hmm. So, and then we had crude, 114. And we had crude bounce up to $130, right? And so there's a lot of things that are out there. So technically, feels like it's a consolidation. Maybe it's going to test a breakout. I think that we break down and kind of see the dollar kind of reverse, and maybe we stay within this range over the next year or 2 years, which I think would be fine. But there is a risk that we see a spike in the dollar here. And the new administration is not going to like that. They're going to try to jawbone that dollar down as much as they possibly can. They want a cheap dollar. Trump wants a cheap dollar. So I just wanted to kind of put that perspective in there because I think it is something that warrants our attention. Moving forward, we can talk about some other products that are going to be associated with that.
It seems like precious metals have been responding to the dollar as well.
Well, the precious metals, so China has reduced or even eliminated in some sense export taxes on a lot of the base metals, right? So if you're looking at aluminum, I think copper is also associated with that, and there's a couple of others. That was announced, I believe, on Wednesday of last week. And so ever since then, I mean, we had one negative day, pretty decent negative day when it comes to copper, but you're starting to get a little bit more of a push when it comes to the metals. I think it's the thought of lower taxes. They're going to be able to export more, right? They're going to bring more supply on. There's also going to be is that a stimulus measure for China? Is that going to spark economic growth for China, right? So I think there's that story as well, rather than the dollar strengthening, because like that's kind of counterintuitive. Like dollar strengthening, usually you would see weakness when it comes to the metals, right, and vice versa. But that was actually something that has been on the radar. Now I think it remains to be seen how effective that policy is going to be for China. And if it is going to create any type of flooding of the market when it comes to metals. I mean, that could be a thing, but for right now, I think the market's taking that as a, hey, here's the next step to economic growth from China, which everybody has been waiting on, especially for a commodity bull.
No, I like that. And also, just getting into the dollar stories, people have been asking me to do this a little bit more now. And I'm always open. All my signal systems, I'm pretty open with any of them. Because I think the thing about trading isn't that, people have too much information or that they know how somebody else does their models or their systems. I think it's the discipline to do it. You're not going to follow a system when what you really don't understand, but I can show you my signals and you can build your own. And so this is basically a 100-day high, 100-day low, long-term system. So if we're looking at this is what I'm seeing in gold. And this pertains to the dollar, because I think one of the things that are really going to benefit from a move down in the US dollar is going to be gold. I think it takes Bitcoin over 100K. I think gold will also do very well in this trend as well. So looking at the long-term signal, everything looks good for gold. There's no reason that you can't buy these pullbacks. We're sitting on the 20-week moving average. We bounced right off of it. We have a huge 2% up move from here. I think you can if you're a short-term trader, you could buy right here, try to trade it to the top of the old highs. If you're a long-term trader, wait for the next breakout zone that Sam and I have laid out on the Gold Rush week after week. But really, I like the idea here. This dollar at the top of the range coming down here could really boost gold, silver, and possibly some of the commodities. I think I think what Kevin is saying, and he could speak for himself in a second, but what I'm saying at the very least, and understanding from what Kevin is saying, and it's a show me story with oil. It's a show me story with oil. I don't know if oil is going to start to move up. I don't know exactly what's going to happen. It is sitting on a zone where if it breaks down, it's going to go a lot lower pretty quickly. But also, if it starts to move higher, if it starts to respond to a down dollar, if it starts to respond to some of these inflation numbers or rate cuts coming in, that's really going to tell us something about the market. And what it's telling us is that the commodity cycle could possibly move, but this is all, we need to wait to see what's going to happen. I think the easiest trades right now are going to be things like Bitcoin, gold, and then go into things that are possibly starting to move into new uptrends like oil. When it happens, it's nowhere near a new uptrend signal. I wouldn't be buying it here. Short-term traders, sure, you could try to trade it here to the top end of the range or something, but I wouldn't even try that. I think that's being too cute right now. I think the best idea is just to kind of sit on your hands. So I want to pass this to you, Kevin. This is a beautiful, beautiful picture. Kevin, if we're looking at Powell and what he said last week, I want to see, basically we were looking at him basically patting himself on the back a couple weeks ago, and now he's kind of changed his tune a little bit. I wrote about that this morning. Let me try to bring up what exactly he said. Of course, I don't have that handy. Sorry, guys. I always tend to do that. Let's see. I quoted it this morning in this morning's post. We can approach decisions carefully, but we have no urgency to lower rates. So Powell said that Thursday last week. So Kevin, what are you thinking about Powell? You think Powell has, you think he's going to change his mind on these rate cuts? Do you think we're going to see more rate cuts, less? What are you thinking for the Fed?
No, I think he's doing the right thing. I mean, the economic data has been relatively strong, better than my expectations. And so we cut rates because of economic weakness and or you hit your goal of 2% on inflation. And we haven't had any of them, right? For the most part, the economic data has been all right. Inflation still is sticky. In fact, it actually did move up in a sense for last month. So, I think he's right. And I think the market kind of gotten a little ahead of itself. I think that's why we saw the 10-year bid so aggressively before the first cut and then that massive unwind, and it continues to unwind. I don't think it's outside of the ordinary though when you see the 10-year where it's at right now. I mean, I kind of look at it and say 2-year, 10-year spread on an average, or if we're looking at the median, even for the most part, both close, sits at around 1.2% difference once we're in normalized markets, right? And so, kind of looking at it, 2-year probably still has a little bit of room to the downside. But even if you have the 2-year sitting at, let's say, 3.5%, you add a percent and let's say a quarter onto that, you're looking at 4.75%, right? 5%. So I think the yield move has been a little bit more aggressive, but I mean, if we do have a higher for longer type of stance, or this is the new neutral rate, or we're getting close to it, maybe it's only 100 basis points from here to the downside, I think he's doing the right thing. The data, he's right. I mean, the data hasn't been that great. I think what I kind of find very interesting is the market has been way too aggressive in its optimism for the Fed, right? And I think it's really healthy for us to get away from being so dependent on rate cuts. Let's be more dependent on economic growth rather than rate cuts. And if you find trades or you find stocks that are able to thrive in that type of environment, then you should be good, right? If you are looking for stocks that are only going to benefit if you get rate cuts, I feel like that's a fool's errand. And you could actually see that one with small caps, and I'll talk about some small caps tried to break out, but I'll talk about them really quick. Ex regionals, small caps really haven't done that much, right? They need regionals. And regionals have done fairly well. But if you kind of look at it, I know a lot of people, and I've been on spaces with them, that they were looking at the Redfins of the world, the Zillow groups. Man, as soon as we cut rates, they're just going to go gangbusters when it comes to mortgage. No, that's not the case. In fact, yields are higher than when we started cutting rates, right? This is the new normalization. I think he's doing the right thing. I do want to kind of bring it back, though, real quick, because I always like to call out winners. I won't say winners, but I want to call out things that we do good and things that we do bad. Last week on the show, gold was traded at 2,700. Looked at the technical setup, said 20-week moving average, sitting around 26.75. So we hit that level last week, actually, which is actually crazy. And if you had one contract or if you had one futures sitting at that 2,700, and you sold it, that'd be $12,500. So I think there's alpha here. Once again, there's not any recommendations that are going to be provided, but that gold setup was just technical in nature for the pullback and where we could see it. If you kind of go back, there's some opportunity there. So that's kind of what I'm thinking about when it comes to Powell. And then you got to look at earnings estimates. And are we going to be able to meet those estimates going into next year too? I mean, that's a huge thing that I think we kind of neglect. And it's been nice because NVIDIA has been able to pad those stats. Meta has been able to pad those stats. Google has been able to pad those stats. But you are seeing some weakness when it comes to guidance, especially on top line. And that's usually a forward-looking indicator. When we talk about top line growth, we're talking about sales, we're talking about revenue, right? You need to have those things in order to churn out profitability, and or you can cut expenses. And a lot of these companies have done a really good job of cutting expenses over the last year. So I think that's kind of the landscape that we have getting into 2025. Earnings expectations, I probably would say, is a little bit lofty. And then Fed policy, I think it is going to be, I mean, if we get 100 basis points worth of cuts next year, I think people should take their ball and go home. I don't even think that you would want more than that next year. I think we should probably still stay at around 3.25 to 3.5% Fed fund. I mean, that gone are the days of we're sitting at 25 basis points for Fed fund rate. Like that's not also healthy. And I think you're seeing kind of the remaining effects of that too, which I kind of caution on, because now you have this mentality from people that recessions don't happen anymore, which is bullshit. And I'll be completely frank with you, right? There's just a lot of slack that's in this market right now. And so I think they have to hold these rates up until they actually do see cracks in the market. And if that means that their new neutral rate is a lot higher than what the market expected, 6 months ago, 8 months ago, then so be it. We continue to move forward. But you don't cut rates when you're printing 2.8% on GDP and hitting 2.2% on CPI and 0.4% month over month, or basically a 4.2% to 4.8% wage growth on an annualized basis. That's not an environment where we've ever cut rates. And I don't think that we should be doing it.
I don't think a lot of people are talking about the transports too. Like a lot of these companies have been talking about rolling recessions inside of their companies. And you have the Dow Jones Transportation Average breaking out to new all-time highs. And it hasn't participated at all during this entire bull market. So if that group of stocks is just now getting started. Like, is the economy really just now turning the corner into a recession?
Probably not.
Probably not.
I don't think so. I mean, like, it could be rolling too, right? Like,
Right.
you're right. We saw the tech recession, what, a year and a half, literally right before this whole AI boom. Tech wasn't doing all that great, right? Before the whole NVIDIA thing, and thank God for it. Can you imagine if we did not have NVIDIA and the enthusiasm
What the
in that
market would look like.
what we would be at? Yeah, we wouldn't be nowhere near where we're at right now. Transportation's been in a recession for the last year and a half. Manufacturing's been in a recession for darn near 2 years now.
Right. And you still have heating oil at that lower bound too.
Yeah.
Is there a catch-up trade there, or is that
Oh,
over?
dude, I've been calling that catch-up trade for the last like 8 months, bro, and I've just been getting slaughtered on it. Like, and that, once again, full disclosure, like we have some pretty good stuff. Heating oil for me has been a mystery. I feel like it should be the most tight, the tightest of all of them when it comes to product supply, and it continues to baffle me that demand continues to wane. But gasoline is at 2-year lows when it comes to stock, when it comes to inventory levels. So be mindful of that. That could be probably your catch-up trade if you were gonna get one. I still think heating oil is, if you look at risk reward for the trade, I mean, the problem that you have is that you don't have options on it. Like, I wish you had options on heating oil, because then that would be like a little bit more, or at least if you had like liquid options on them, right? Like if people actually traded them. But I feel like that would be the risk reward would be heating oil. I also want to kind of talk about Natty, because we talked about Natty last week. Natty was sitting at what, $3? I believe it was up like 14%. So
I can't get above 3.
yeah.
Yeah.
And that's why I was like, hey,
That's-
from a technical standpoint, like, look for that pullback, right? Because it's like, what is going to give you the reason why it should stay over 3 right now? If the weather is looking decent, supply continues to ramp, what gives you that reason right now? So yes, last week that was a decent fade, trading around 3, came down to what, 272 and some change. I mean, that you're talking about $4,000 right there, like really tactical. Now, the dynamics have shifted a little bit, so I'll be a little bit more cautious when it comes to natural gas, because of what has occurred over the weekend. And I'll probably kick it back, Jason, because I know that you may want to actually talk about. I saw a couple of posts around some of the geopolitical events, which is why I'm kind of saying last week it was easy scalp to fade it at 3. You might be able to pull it off again, but that thing was coiled up. I mean, Sam will tell you from a technical standpoint, it was a decent pullback, but I mean, it still was actually technically a higher low in this whole wedge pattern that's been developing for the last 2.5 years, 3 years. So it does look a little bit scary. But Jason, I want to kind of kick it off to you. What are your thoughts? I'm just completely just took the show over, dude. What are your thoughts
You're good, man.
when it comes to Natty?
Well, I've got one more to add on that. Like the
Yeah.
COT on the natural gas.
Yes.
I personally want to see the commercials flip net short.
Oh,
And that could
be
be the
careful with
catalyst to
that.
resolve this.
Be careful with that, because we will have a roll. The roll happens in like 10 days. So be careful. That's another reason why natural gas was doing what it was, why it was getting pumped up so much last week, especially early on last week, is because that UNG ETF, the United Natural Gas Fund, was doing its rolls. So when it's doing its rolls, it was net. It's for the most part always net short. I mean, natural gas has been like that. So you had a lot of buybacks. So that's what I was like looking for. And still, until I saw the buybacks kind of like fading out, like, oh, okay, and then it was just like boom, straight to the downside. Then we had some news, but that COD report is going to be a little bit deceiving. So just be mindful that we have 10 more days on this contract for Dees. We have 8 more days on the contract for Dees. So you're going to start getting the rolls. Like, I mean, they've already started happening last week. You'll get a lot more aggressive rolls over the next couple of trading sessions. Even more of a balance out when it comes to the Jan contract. The Jan contract is trading at $3.15. The Dees is trading at $2.91. We have to remind our viewers what happens to futures contracts as they get closer and closer to the roll, right? They're going to come to whatever the price parity is. So either one's going to be coming to the downside or one's going to be moving to the upside here. And it looks like January's got the upside advantage above that $3. So that was the trade last week. It was like, all right, wait till UNG gets out of its whole thing, because it was just rolling aggressively. You could see the blocks that were just hitting the market, and as soon as they were kind of done, boom, faded. Now I think the dynamics have changed. So what are your thoughts on the Natty trade?
So that's it. So Kevin, a while ago I sent you. So I have a product that I've been building with a friend for a while. Basically, detrend seasonality models. And Kevin, I sent you this a while ago, and we talked about it, and we're wondering why that exactly happens. There's this huge bump that happens around the roll time. So near end of the month, it's almost like just every single time, it was a 90% win rate. So 90% of the time, you see this bump in natural gas into the end of the month around the roll. So something to watch out for here, to look for that breakout. Once again, that could just be enough to trigger this breakout that we're looking for above this 3 level. If we get above that, I'm very bullish on it. We had a reversal trade in it at against All Odds Research. That reversal trade has worked out really, really well so far. Now we're looking for this breakout trade to get long in our trend models. I really do think that natural gas is probably the best trade in energy right now that nobody's looking for. Ooh. Everybody's looking at the equities.
It's a hell of a statement.
Yeah,
that's a hell of a statement, bro.
Everybody's looking at the equities, right? Everybody's looking at the equities.
Yeah,
everybody's looking at the oil. They're going, oil's not going anywhere. Heating oil's not going anywhere. Energy's dead. And it's like, natural gas stocks have done really well. Yeah. Natural gas itself is starting to kind of pick up. Now, once again, like the front month is what looks best. And Kevin, you know this better than I even do. The front month bouncing the way it does, and the rest of them not really. The rest of the charts, if you go out further on the curve, they look worse and worse and worse. Yeah. That's not a really good sign just yet. But we are starting to see some bottoming out. So you look at the February contract, you look at the January contract, we are starting to see these bottom out a little bit. Yeah. So once again, for me, I'm kind of getting to the point of going, okay, it gets over 3 on the continuous contract. That's the contract. If you guys just search NG on the continuous contract, if we get over 3, I'm pretty bullish on that space. Ooh, I think it's a pretty bullish trade. Once again, it's natural gas. It's a scary trade, but man, it's when that thing moves and you're making money in that trade, you're not going to be worried about the Widowmaker. So I would more just say it's an easy risk level. Get above 3, I really like it. We're below 3, I really don't like it.
Dude, the short last week was printing.
Yep.
Hand over fist. I was loving it until we got to Friday. But
that's how it goes. That's how natural gas goes. You get these crazy bounces and these reversals that happen, and it's not a bad thing. It's just how it goes. Like this is natural gas, so they make micro contracts in natural gas. Get to the smallest contract you possibly can. Try to ride that trend, and it's the only way to really hang on to it. Because if you're too big in that position, a 10% move up or down that can happen in a day or two. So once again, if you want to ride the trend, you got to have small positions. If you want to catch the bounces and turns, like you're going to have bigger positions, but look out for those reversals.
Yeah. So you could buy so there's 15 days left to go in this contract. And so in my head, it was like, and this is an example. I'm not saying that I actually traded this, guys. I can't say that. But if you were to have somebody that were to trade this last week and looking at the 295 puts out there, the fact that you have so much time, you have to buy time with natural gas because your price level will hit. Like that's one thing, it will hit. I don't care if you got a call on, or if you have enough time and you can weather the storm, your price level most likely is going to hit. You just need to have time. And sometimes those contracts, you need to take like 5 cents to the downside in order for them to kind of like wake up, right? Like, so decent trade. So here's the dynamics that have shifted that I wanted to kind of highlight here. And I know Sam, you had some things that you wanted to provide. A couple of things. One, so the Russia-Ukraine conflict. So there's a report out there that that Biden has approved the Ukrainians to be able to utilize long-range missiles in deep into Russia, right? it's a report. There has not been anything that has been confirmed on one side or the other. Even the Russians last night, the Kremlin statement, one of their statements was this was not an official report yet. But if it were to be the case, we actually do see that aggressive nature being taken place here. Then what's the risk? Obviously, right? We have transportation risk. They're still literally providing flows for natural gas to Europe, so there could be some supply disruptions. Austria just got cut off from natural gas flows from Russia over the weekend. I want to say it was Friday or Saturday. So that's actually a pretty big deal. Jason put the two links into the description or comments or what have you, but
it's on the comments on YouTube.
Yeah. So two months ago, I rewrote this article, and actually we talk about everything that I write about, and he talks about everything that we write about. So when we say like we wrote about it 2 months ago, it's like we also talked about it on the thing. You can check it out. Yep. But we talked about the disruption of your uranium flows too, right? Like that could actually be a big lever. Russia, depending on the source that you look at, supplies between 20 to say 30% of enriched uranium for the U.S. for nuclear reactors that are used for power generation. Okay, that's got to be very specific with that. But now they're saying, and they came out with a statement on Friday, they're going to limit that. Now it's not going to have an immediate impact because when you buy uranium, just like when anybody that buys something, they're not buying something like a month out and then saying like, oh, we need this thing. So you're not going to see any type of disruptions in by the end of this year or anything, or like next week. Your utility bill is not going to spike to the upside. But if they continue and they actually do cut us off completely, there could be a major problem in 2020, mid 2025 to end of 2025. Because usually those individuals are buying out their supply year out, 2 years out, right? So that's another reason why we're seeing Natty catch a little bit of a bid, right? So that could be one thing. LNG demand could be going up as well. But what does that mean for the small nuclear reactor trade? That's the one, because I am very optimistic when it comes to that trade. But if I'm a company that's trying to expand AI data centers and I'm looking at the nuclear side of the equation, and then I just hear a report that, dang, we might have some issues obtaining the main thing that we need for the supply of these small nuclear reactors in 2 years, 3 years, 4 years from now, am I going to put money down that road, knowing that they might have that issue? And you can't just spin up uranium operation. Like that ain't how any of that stuff works, right? So I feel like the dynamics have shifted a little bit when it comes to the natty trade, and then when it comes to the crude trade. The crude trade, I think, still needs China. The natty trade just needs a narrative. Now, Trump can come in and completely reverse all of this stuff, but in the next 30 days to 60 days or whatever, it's only all you have to do is hit Russia really hard once, right? And I would care. Trump ain't no superhero. I can tell you that. Like, it only takes one thing in order to kind of like create this domino effect in markets. So it makes that natty trade a little bit harder for the short. Other side of that, it still makes it hard for the long for me, unless we get the weather. Like, I need something more than just geopolitical. It's a nice icing on the cake, and it's a really bad way to say that, right? It's a good catalyst starter, but it's not going to be the end-all be-all. We need the fundamental case end-all be-all. The EU is also drawing down their natural gas inventory levels actually relatively quickly compared to what the expectations were. I believe their inventory levels are sitting just above 90%, and they should be at like 97, 98%. So it could be a problem. Once again, there's kind of like this whole domino effect. So I want to kind of highlight that when it came to the natty trade as well.
No, I like that. And I think we had even a chart from last week on natural gas. You know, like this is the level that we're really all looking at right here. That makes a new 52-week high. That makes a new 200-day, 100-day, 52-week. All of those would be triggered around that point. So something to continue to look for in the natural gas market. And just another thing, I forgot to get to this because I was too busy looking at this picture and laughing too much about it. This one. So this is the spread between the Fed rate and the 2-year yield. And if we're looking at the spread between the Fed rate and the 2-year yield, we're only 50 basis points to the 2-year yield at this moment today. That's something to think about because the 2-year yield tells the Fed basically what to do. And so if we're looking at this and going, there's going to be a ton of rate cuts next year, and there's going to be a ton of rate cuts to end this year. I'm not saying they're going to stop. Like there's people who are like, they're done. No, I don't believe that at all. I believe they're going to cut again. They got to save face. They're going to cut probably 25 basis points. Maybe you get another one next year, but that's it. I think the Fed at some point is going either the 2-year here starts to go down really hard, which I know, Sam, you probably have a theory about that, or we see a situation where the 2-year continues to rise and the Fed rate is at the same rate as the 2-year yield, and they're going to be forced to make a decision at some point. Usually the 2-year yield leads. So the 2-year yield leads down. The Fed usually chases it. If you go backwards, you can see the opposite scenario. The 2-year yield started to move up. The Fed chases it up. So once again, this is a chart that once again you should have on your list. Pay attention to it. See where this goes, and it's going to kind of tell you where the rates are going to go going forward. But just back to natural gas real quick. What we keep talking about is these levels. And Sam, you're looking at very similar levels to me. I think you have an even better looking chart. Sam makes better looking charts than I do. If you look at this chart here, this is Sam's chart. This is a more tactical view of it. And this is the volume shelf or open interest shelf because these are futures. And that's the amount of participants around certain price levels. So volume by price is those gray lines, those shadows that you're seeing on the right side of the chart for you. So if you're looking at that and we get above that VWAP as well, that's all at that $3 level. So if we get a nice close up there and we start rallying higher, that's really like there's no price memory basically until we hit $5.50. So, I mean, that can happen really quickly. So I like the way you did this, Sam. I like the way this chart is put together. And that's a Head and Shoulders bottom. It's a nice reversal pattern. I don't care if it's a Head and Shoulders, a rectangle, whatever it is. I'm just saying it's a basing pattern. That's all you need to take away from that. So it's a nice basing pattern with a perfect risk level around that $3 level. So once again, below it, you could probably short it. Above it, though, if it breaks above it, that's a tight coil. And that's a Bollinger Band squeeze. So Bollinger Band squeeze breakout above volume support, above VWAP support, it's an easy buy. So I definitely like natural gas. I'm glad we got to chat on that today. Kevin, real fast, we got 5 minutes. Let's hit the grains. You get any thoughts on the grains or any of the softs? Like, feel free to pick whatever one's on your mind today.
Yeah, I think the grains are still ultimately weak. Now they are kind of basing out. You also have the seasonality effect. You should see some covering when it comes to end of harvest, especially when you're looking at corn and soybeans. But we've had favorable weather when it comes to the planting season for wheat right now, and South America also has some pretty favorable weather. So I think you are seeing a bump in exports right now, and I think it's trying to get ahead of any type of tariff policy. Until we see those tariffs in place, and if we do see a drop off, then that's how I'm a little bit more cautious on the grains right now. Even though you're kind of getting to an area of 3-year area of support, getting kind of close to it, depending on which grain that you're looking at. But yeah, I mean it's hard to be really optimistic on it until we kind of get through these political headwinds, in my opinion. And that's going to be a major factor this time around, because it was a major factor in the first Trump administration, and one of the reasons why we saw grain prices, for the most part, crash.
Nice. So yeah, just looking through the softs, Sam, is there anything that's sticking out to you? Because we've been talking about this one. Well, I will say one that I'm thinking about, obviously off the top of my head, makes you have to run to the bathroom sometimes. It's called coffee. So coffee hitting new highs again. What are you thinking about coffee, Sam? You're the one who brought up this amazing chart a while ago. I'll see if I can dig it up. Just basically showing this massive basing pattern that's been going on since the beginning of coffee trading in the United States, at least. So what do you think about coffee, Sam?
Right. Yeah, we've been talking about this massive base for coffee for a long time now. Personally, I think coffee is the next cocoa. I still think that's the case. Obviously, it hasn't been the case yet, but I think if you give it some more time, I think coffee will make a big impulsive move out of this space. Cocoa also looks really interesting. Cocoa has already made a massive move, almost 500% rally. It's corrected straight sideways all year long and has not been oversold on that daily RSI. It's breaking out of a little potential continuation pattern. So I think cocoa, coffee, the softs in general, I think you can throw sugar in there, orange juice, you can keep going on down the list. The softs are the place to be right now.
The softs look really good.
Follower.
And I have to give another shout out to Sam. Kevin, on the show last week, Sam was on, and I'm sitting there and talking about he took cocoa or something, and he asked, I think you were on too, and he asked both of us. He goes, "What do you guys think about cocoa?" And I said, I don't have a signal. I'd be very surprised to get one again. This thing is just, it went parabolic. They usually don't move up after that, and I never get a signal again. Sam goes, "I'll fade that all day." 20 minutes later, I get a signal, and I have to send it to Sam and go, "Hey, Sam, I got the signal."
I remember that.
Well, it's because I study intermarket analysis. I saw the exact same chart in crypto, and I was just betting on this commodity looking the same.
Very
That's all
similar.
it was. I'm
And
not
it's
a
simple.
genius or anything.
Yes. And that's honestly like something that it's the reason why I use systems, because I think over time, like no matter what type of trader you are, the more you know, the more your brain's going to work into certain things that sometimes don't even matter. And so if you keep it simple and go, okay, I'm just going to buy this on the signal. This is what my model is saying. This is when I short things. This is when I buy things. Then you can at least take it out to a very simplistic level. And even if you're wrong, sometimes you have to fade yourself. I think that's a hard thing to do as a trader, is like, I have to sometimes tell myself, Jason, you're an idiot. You built these systems for a reason. They work. You sometimes get things really wrong, which is normal because we all have biases as humans. So follow your systems and shut up. And I have to do that to myself a lot. So good job. Good shout out to Sam picking that out. Kevin, anything to end on before we take off?
I'm going to take the other side of what you guys are talking about. I think you fade coffee, cocoa, cotton, fade sugar, all oversupplied for next year. I think there's a technical balance that's in place, but I think the fundamental case is going to be a little different than what we saw this year. But doesn't mean you can't ride the trend while the trend's going up.
The trend
what
is
do you
your
think
friend,
about
Rob.
coffee, Kevin? I want to ask you that. What do you think about coffee? What about Brazil? Like we haven't gotten any of those fun conversations lately because of the election. So I'd love to hear your thoughts on this.
So industry experts are expecting a significant amount of supply hitting the market in 2025. And then we'll actually get those new estimates coming out in January. So like there might be a time period between now and like, I think it's like the middle of January 20th, around the 20th, whatever, where we might have, continued buyers getting in, but the market is expecting a significant amount of supply for coffee, cocoa, especially coming out of West Africa. Market is expecting, or analysts are expecting, a significant ramp up in cocoa for next year. And then also for cotton, which we have a significant amount of supply, that also is going to be one of those bigger levers that people can pull if we do have a tariff war. So there's also that's
cotton's a tough one. Cotton for me is probably the toughest trade in that whole complex.
Yeah, I don't even touch it.
I don't even touch cotton. Coffee honestly is the one I'd be the most bullish on. Cocoa I'm skeptical on, but we're long because and
the thing is that like
cocoa.
You gotta go with, especially when you're looking at the softs, fundamentals mean a lot, but if you get enough enthusiasm in a product, you can push it higher, right? Bitcoin's doing that right now, in my opinion, right? You guys probably have a little bit different thesis when it comes to Bitcoin, but my thing right now is Bitcoin's one of the, and making a move that it's a crowded trade and everybody's looking at and eyeballing 100,000 and they want it to get to 100,000 and it probably will get to 100,000, right? What happens after 100,000? Who knows? I still feel like there's still a utility problem when it comes to Bitcoin and crypto in general, but that doesn't mean that the price can't go up. It's just one of those situations for me where the fundamentals don't really match up to what the price action is doing. And we have those different, disconnects in markets all the time.
Oh yeah.
So my thoughts around the softs is more, everybody's going to give their economic. I mean, you're already seeing the SPX targets for next year and outlooks. All that stuff's going to be coming out over the next month or so. Same's going to happen with the commodity space. And I think that we'll probably see a lot more optimism when it comes to supply growth in a lot of those softs than probably what the market's pricing in. And I will go on the other side of that and say I think you're going to see the same thing for cattle to the downside. And I've actually been, cattle's had a really heck of a move right here in the chart. It's really hard to fade, but there's also a notion that cattle could also cattle supplies as well as weights. Maybe not an outlier just for this year because weights have been completely more aggressive than what we see on the 4-year average. And even if you compare it to last year, there's a notion that would actually also continue into next year. That could also bring prices down. But on the other side of that, Robert F. Kennedy Jr., which is going to be one of the biggest wild cards that I think in this whole administration. There's a lot of interesting individuals in this new administration. Just say it that way. But the commentary coming from Robert F. Kennedy, and if he's actually going to implement some of this stuff, might be actually really wild when it comes to from livestock standpoint.
Mm-hmm.
There's commentary over the weekend that he wants to have tallow being used for cooking fries again at McDonald's, rather than the oil that they're using right now, which would be a massive shift. And tallow, for people that don't understand or don't know what that is basically beef fat that's just rendered down. And so like when you have a thing of beef, you cut it up, you got like these white pieces, which is the fat.
Yeah.
And if you put that in a pot, you could actually melt it down, render it down, you filter out all of the impurities, and it comes into this like white solid once you put it in the refrigerator or what have you, right? Kind of similar in a way, like when it comes to the look of like lard. But if that's going to be the case, I don't know if he actually has the authority to force a company to do that.
Yeah.
But like all bets are off with this whole administration, in my opinion. So like I say, you take them at their word. Like maybe they do have they're going to find a way. They're going to find a way. And if that is going to be the case, then there's going to be a renewed strength for cattle like we probably have not seen in decades,
or
right?
ever.
Because yeah. So that there's always like a what if now for me when we talk about these markets. It's like a little bit less surety for me, right? Because like they're stuff that I didn't think that was going to happen have happened, so I have to give them credence. Right now, it seems like cattle could be a fade for next year. You bring tallow back into the mix and the biggest restaurant chain in the world. Now there's going to be certain areas of the market. Maybe it's only going to be in the United States, right? Because like, I don't know if you're going to be able to utilize tallow and like,
but it would still affect our cattle prices,
It would be, right. The demand for everything.
Yep.
Yeah. The demand for cuts. I mean, you're talking about the bottom of the bottom. It's not even the bottom of the barrel. Tallow is actually phenomenal, dude. Like if you guys have not, and gals have not actually like utilized and broken that down, I mean, one, you save a whole lot of scraps, and two, it's actually really good, especially if you're like cooking bacon and stuff like that. You throw some of that stuff in there. Okay, let me not go on a whole tangent.
No,
but
I love it.
That's one of those areas where it's like, okay, what do you do? There's another rumor that he's gonna force Coca-Cola to use sugarcane next, like force them to go back to sugar instead of utilizing high fructose
corn syrup,
which will be a problem for the corn markets if that is going to be the case, right? Like, so there's all of these different like things that we have on the horizon. So I love the charts.
Good for sugar, bad for corn.
Right.
It also looks like like it's part of the soft story. It could be some optimism behind those things, which is kind of interesting to think about now that you're bringing all this up.
Yeah, and like I said, I would just capstone it by just saying like I'm 70% chart guy, right? I love the fundamentals. I think that there is a question mark, an asterisk near a lot of the fundamentals right now that we just don't have clear answers to. And I feel like that is going to, one, provide a little bit more vol in a lot of these products until we get more clarity. And two, it can completely shift the dynamic, right? Like the energy secretary that they just announced that most likely is going to get through. He's a guy from CEO out here in Colorado, right? Like that's huge boon for natural gas and fracking. Like that's going to be a massive thing for them, right? The expansion of LNG, like that was a question mark a week ago. Maybe not much of a question mark right now, but Yeah, so I think there's a policy play. There's policy plays across this whole market, equities, commodities, and that's just something to keep in mind.
No, it's an interesting thing to keep in mind. And then one more thing, we were just talking about Bitcoin, and I just wanted to add one thing to it. The other week I wrote a report just on Bitcoin talking about the down dollar. We already talked about this before a little bit the other day too, and today even a little bit. But I think the down dollar is the key thing that we need to continue to look for here. If we're going to see Bitcoin really get over 100K. Now, granted, I'm with Kevin on the whole fundamental idea on just about everything, and that's the reason why I'm so heavily wedded to price action, because I love the fundamentals. I love looking at them, and they do matter at a certain point. But mainly the things that matter in the short term in our trading accounts for 6 months to a year time frame, even you're really looking at intermarket analysis. You're looking at relative strength, and you're looking at trends. And for me, the dollar moving down, whatever Bitcoin is today, would absolutely take Bitcoin over 100K. And something that I just want people to take home with them: if something passes 100K and it's as volatile as something as Bitcoin, that thing is going. Remember that 100K is a psychological level. We have price levels, which would be when we got over 72,000, and then we have psychological levels, which is 100,000. Things that pass those major psychological levels usually run another 10%. Something like Bitcoin can easily run another 20%. So seeing an easy trade for that day, and something for people to think about, if we get a sustainable close over 100K, I would absolutely think that thing can move to 110, 120 pretty easily. So, you're a short-term trader, 110, take half off. 120, take the rest off. Make a short-term trade. Just a thought I had. Feel free to use it. Don't use it. Not a recommendation. Just an idea. All right, guys. You guys have a good one. And make sure to follow the speakers. We got KG Bull and Bear up here. We got Sam Gatlin. I'm Jason Pers, and we'll see you guys next week. And we got a show also on Friday, the Holy Macro Show. So we'll be on at 11 on Friday. And we'll see you guys soon.